Welcome, everybody. I am Sarah Snell Cooke, and we are here with the Credit Union Connection. I have with me today Bryce Deeney, who's the CEO of Equipifi. Welcome.
Thanks, Sarah. Yeah,
Well,
happy to be here.
yeah, welcome back, actually. You've been here before. Equipifi offers buy now, pay later services that credit unions can take advantage of to offer to their members. And so we were talking about the CFPB's new rule that I'm going to say it generally defines buy now, pay later as credit card issuers. Just explain, if you will. You're the expert.
Yeah, well, what I will say is to understand the current ruling, you kind of have to go back in time. So, buy now, pay later, for those of you who are kind of understanding, like, what's the definition there? It's a consumer loan, an unsecured consumer loan that's tied to a specific purchase. Back in the day when I was a kid, we walk into the furniture store, we'd want that couch, and they would say, "Hey, just fill out this application, you can finance that over time." Technically, that was a variant of buy now, pay later, and I think before that, you'd have store credit, right?
Mhm.
In fact, I remember going to like the local convenience store and getting the Snickers bar, and they would put it on credit, you paid at the end of the month. Well, buy now, pay later in its current form is an immediate variant of those products that preceded it. So obviously, the regulatory bodies in the U.S. hadn't really caught up to the instant underwriting and instant lending component that is buy now, pay later today. So the CFPB recently put out an interpretive ruling that says buy now, pay later lenders. So think of the large brands in the US like Klarna and Affirm and Afterpay and PayPal, and there's dozens of others, but those are kind of the four big ones. Now are subject to these same truth in lending requirements that credit card issuers are. So things such as having periodic statements, things such as understanding a consumer's propensity to repay, making sure that if a consumer returns the uh, item back to the store where they, bought this thing, but bought it through the mechanism of buy now, pay later, that the returns and exchanges and refund processes follow the same guidelines that traditional credit products like Visa, MasterCard, American Express already had today. So the short answer is now third-party BNPL providers are essentially offering the same protections from a legal framework as if I swiped my credit union, Visa signature card. I have a lot of other thoughts about this, but I'll kind of pause there and we can keep the conversation going.
Yeah, yeah. Well, so one of the things that I read about in the or in an explanation of the reg is that 13% of the transactions involved disputes, like you said, with the return, something happened with the return or other disputes, and that was part of the protections they wanted to provide. Um, and so what are your thoughts on that? What the reg actually is doing for consumers? Let's start with that side.
Sure. So yeah, if you break down like the four or five main points of this interpretive ruling, I do think the one that really has some sticking nature that should help consumers over time if they prefer to use buy now pay later from those direct to consumer fintechs that I mentioned earlier. Uh, it is going to have a forcing function where the Affirms and Afterpays of the world are going to have really, really clear return and refund policies that they have to follow. Where prior to this interpretive ruling, they kind of were left to their own devices of how to handle those disputes and returns and refunds. I will say, I definitely don't, have these types of conversations to defend the direct consumer fintechs. Well, obviously, they're a direct consumer brand, right? Just like a credit union is a direct to consumer brand. And it's in their best interest to offer the best products and services available to consumers. That way, those consumers continue to come back and shop and use their
Mhm.
card products and eventually other products that they offer. So I actually don't think it's going to have a huge impact to the consumer experience, but it does offer the same protections
Right.
that traditional card products do.
And so is this going to affect Equipify at all?
No, for those listening who aren't really aware of who we are, we're just the technology provider or the infrastructure that enables existing financial institutions, which we predominantly serve the credit union community today, to offer buy now pay later directly to their member base. So
Mhm.
just like Visa offers credit cards and debit card products, Equipify is a buy now pay later technology provider. So our existing clientele today are already regulated financial institutions that offer products like debit cards, credit cards, unsecured signature loans, HELOCs, mortgages, auto loans, etc. So the way that we built our technology is already inside of the regulatory framework of the regulatory bodies, such as the NCUA and the CFPB and other regulatory bodies, depending on your institution. So we built it in a way that actually attaches it to the existing debit card the consumer already uses, which has Reg E. Like if there's somebody listening who's a huge card nerd, you're going to know what I'm talking about. Um, on the debit card side, consumers have Reg E protection, so you already have protections as far as um, returns, refunds, and disputes. All of our clientele already offer, for example, truth in lending disclosures that are kind of flowing through our platform. Consumers already get periodic statements. So there actually is no change for our existing customers um, once this rule goes into effect, which I think, if I look at the calendar, it's maybe in like a month,
Mhm.
4 to 5 weeks from now.
And you were specific to say existing customers. What about going forward? Are those prospective clients going to be affected by it?
What I will say is they're not impacted by the regulatory framework. Actually, what this has caused for Equipify is an influx of demand. We've had a lot of institutions over the last few years as we were building out our company and our QSO. A lot of institutions who were sitting on the sidelines just because there wasn't clarity from a regulatory perspective on how they should look at buy now, pay later. Should they dip their toes in the space or not? Now that there is some clarity around this, we've actually seen a significant increase in demand of institutions who are saying, hey, now that we have a green light, let's go ahead and start pursuing and offering this to our members.
Yeah, yeah. And so I wanted to move on to a little bit broader, and you sort of good segue there, as far as like the broader market questions. So in 2024, by the end of the year, buy now, pay later is expected to grow 12.3% year over year, or $80.77 billion. And given the current environment, do you think we're going to hit that? Is the demand still there?
Uh, Obviously, I'm very bullish on buy now, pay later. It's why we founded the company a few years ago. I actually think those numbers are conservative because those are industry analysts looking at Klarna, Affirm, Afterpay, and PayPal's growth and extrapolating that over the next few years. They are not taking into account that millions of consumers are now able to take advantage of the power of buy now pay later from their trusted institutions. And we see this already today. Our clientele who launch debit card BNPL see more usage than their members use third parties combined, right? So if you look at a 50,000 member base, they're actually using that credit union's buy now pay later more than they use PayPal, Affirm, Klarna, and Afterpay combined. So these analysts really haven't caught up to what it means if the incumbents is what they call them, the traditional financial institutions offer this directly as an embedded experience. We see the growth rate significantly outpacing what the analysts are saying.
And I would think it's more seamless for the consumer too, because they only apply once, right? Because it's attached to the debit card. It's not like you got to apply BNPL every time you want to use it.
Yeah, in fact, Equipify built this in a way that the consumer doesn't have to apply it.
Yeah.
So for consumers who, let's say they bank with a credit union today, they use a credit union debit card or credit card, but they love BNPL and their credit union doesn't offer it. When they go to Sephora.com, they see a Klarna button, right? So they apply for Klarna, they get their Klarna loan, they get their Sephora goods, and then they go to Lululemon's website, and a Lululemon may be partnered with a firm, right? And you can kind of go down that decision tree. Eventually, that consumer now has relationships, and they've applied for, uh, sometimes three, four, or five different providers, and they have loans with all these third-party providers. And the only way for them to actually manage that financial experience is by logging into all of those apps and then logging into their credit union app to see, do they actually have enough money for that next biweekly or monthly payment. So you're 100% correct. Now that the consumer has that experience bolted into their checking account from their digital banking app, from their trusted provider, now they can log in and decide which transactions, Lululemon or Sephora or Walmart or Amazon, they want to split up over time. And there's no application, there's no process to manage those because it's tied into your DDA that your debit card's already attached to.
Very cool. Yeah. And so, I mean, liquidity is tight right now for credit unions anyway. Lending has slowed down intentionally because they've had to tighten underwriting. So, how are credit unions going to be able to keep up with the consumer demand with the current environment?
Yeah, I think so. This is going to be a little bit of a long-winded question because talking about like current landscape on lending liquidity is a very large topic. But if you kind of go through the last few years, we had the stimulus money that flushed cash. The credit unions were like, hey, how do we lend against this? But interest rates were low, so they weren't making a high ROA or ROI on the dollars that they were lending out.
Mhm.
And then we had the fastest rate hike in modern history. Stimulus money kind of dried up. And then there was, like you said, this liquidity crunch of the deposit to loan ratios at that point. Um, However, so credit unions did tighten their underwriting, and then now you see mortgages and auto loans at extremely high rates. At least in my lifetime, they're the highest that I've seen as an adult. Uh, One of the problems we're seeing now is kind of the pendulum has swung to where credit unions actually aren't able to issue enough loans because consumers are not actually taking out those large dollar long-term loans.
Mhm.
But with high inflation comes high unsecured consumer borrowing,
Mhm.
right? So we have seen credit card balances tick up. We've seen a significant increase in usage of buy now, pay later because consumers do want to finance, for example, that vacation or that couch or that medical bill, but maybe they're not buying a new home yet. So credit unions actually on their balance sheet, we've seen that pendulum swing where a lot of them are actually looking for profitable short-term loans that turn over quickly because then they aren't taking on that 7-year 8-year risk on an auto loan or a 30-year risk on a mortgage, and then they now have a loan product that turns essentially the entire book turns every 6 months to where they can make a profit on that, and there's high demand for it as well.
Mhm. Perfect. Yeah. And so, you kind of for all the reasons you were explaining at the beginning of what you were saying as far as consumers, and inflation, and we've seen delinquencies tick up in all different types of loans. How are they performing as far as delinquencies for the BNPLs?
Yeah, so BNPL today, now obviously I'm only talking about Equipifi data, performs 2x better than unsecured consumer credit cards. There's a lot of reasons for that. The first and foremost is we do cash flow underwriting real time. So if you look at a credit card, right? When I applied for my credit union's credit card, they ran my FICO, ran my DTI 7 years ago, gave me my Visa signature card, and then essentially now they have to just hope that I continue to pay out my bill every month, and they kind of extend that risk out in perpetuity over time. Well, because of that, when interest rates rise or unemployment rises or there's a change in the macro environment, delinquencies are going to ebb and flow, right?
Mhm, mhm.
Buy now, pay later, again, on that short term nature of the actual loan type, when you can have a high degree of probability that Bryce has a high propensity to repay this particular uh, that means that this particular loan is going to be paid off the majority of the time. So having a 30-day plus delinquency, sub 140 basis points on a product like this, performs very, very well, especially in this environment compared to the other loan products that credit unions offer.
Yeah, absolutely. So you've been on here before. I'm going to ask you final thoughts as we wrap this up. What do you want to share with credit unions?
I think it's really fascinating. A few years ago, zero credit unions offered a true buy now pay later product to their member base. We kind of came out of the woodwork in 2021 and said, hey, like there's a market here that credit unions are missing out on. You're going to start losing wallet share. But at the time, third-party BNPL providers were kind of one-trick pony fintechs, right? Which is how most direct-to-consumer fintechs start. Like, hey, we will finance this one product. Over the last year, we've seen consumers switching their top of wallet card from their credit union or the primary financial institution to the Affirms of the world. The Affirm debit card, 70,000 consumers are switching to it as their top of wallet card every single month right now.
Hmm.
So I think because of that and all the other topics that we discussed today, we've seen a lot of credit unions get into the game. So far this year, we've launched one credit union about every week so far. I think that number is going to double or triple next year as more and more credit unions understand, like, hey, this is a credit product or a credit union. We should stay relevant for the next generation. Last thing I'll just kind of drop in here right now is because of that demand, we're actually hosting our first Equipifi event at the end of the year.
Neat. Yeah.
We weren't really sure what that was going to entail, but we're like, hey, let's just invite credit unions to Phoenix and when it's not 120 degrees and see if they show up. And, now we're realizing we might need a larger space. So like the opportunity is real, and we're so excited to partner with all these credit unions.
That's awesome. Well, thank you so much for your time today. I appreciate it.
Thanks, Sarah, as always.